Chrissy, and welcome everyone this afternoon to Rev Rec Part 5. This is the 5th webinar in our series, and there are a number of webinars that will follow as well. Today we're going to talk about some changes that happened to some of the bigger changes that are occurring to some of these industries. We won't cover all of the industries or all of the industries that are impacted significantly because we will have some industry-specific guidance webinars coming up. Let me introduce myself. My name is Michael Hoos. I'm a senior manager out of the Raleigh office. I'm part of the professional practice department, and I spend about half my time serving clients, mostly SEC filers in the tech, life science, and manufacturing and distribution industry, and the other half of my time teaching and developing content such as this or managing our firm's resource desk and answering technical questions. Let me just go ahead and jump right into what we're going to talk about, which is we're going to go over these 4 industries. Now, if you don't have clients in one of these 4 industries, a lot of these concepts will also apply to other industries, obviously, because 606 is a principles-based standard that applies to all industries. It just so happens that certain industries are going to have a bigger change, and here's some of the 4 that will. We're going to talk about broker-dealers, engineering and construction, healthcare, software, and SaaS. And again, there are other industries that are impacted significantly, which we'll probably go over in other webinars on those industries. So we all want to get our CPE credit, so let's start our first polling question, which is what industry is your specialization, if you have one? Again, let's make sure that we get our CPE credit. Again, you got to enter it into Engage You. Give everyone a few minutes, a few seconds here to enter in their answers. All right. Again, you just have to click on one answer. It doesn't have to be the right answer because there is no right answer. Any specialization is the right answer. All right, so let's go ahead and close that polling question. So a very brief kind of refresher on Rev Rec. So Rev Rec's going to have to be, 606 is going to have to be adopted for our public companies for this coming calendar year, 2018, and 2019 for our private entities. So hopefully you've been able to catch some of these webinars, and these 5 steps are not new to you, and you have them memorized even. These are definitely going to be 5 things that you will memorize eventually, and hopefully sooner rather than later. And so let's just kind of refresh what those 5 steps are. And the first step is to identify the contract. That's going to be a very easy step for most folks to do. Generally, the only big change there is for contract modifications. There's now explicit guidance on how you treat those contract modifications, if you have to treat them as a whole new contract or if you have to combine them in one way, shape, or form with the original contract and treat it as a single contract. I don't anticipate a lot of folks having problems with step 1. Step 2 is identifying the performance obligations. Performance obligations are the unit of accounting now, and so that means you're going to separately allocate some revenue and separately track that unit of accounting and measure a progress towards completion for that particular unit of accounting. Identifying performance obligations is arguably the most important step in the process, and you just need to understand the concepts of distinct and capable of being distinct. Again, if you need a refresher on that particular stuff, I would take a look at Rev Rec Part 2, which talks about steps 1 and 2. And then the third step is determining the transaction price, and then that's one of the beautiful things about 606 is that it's very intuitive. You know, you identify the contract, then you identify what your units of accounting are, and then step 3, you determine your transaction price. Think of that as like the big bucket of money that you're going to have to separate and allocate to each of those performance obligations you determined in step 2. And so the transaction price, the biggest change there is variable consideration now is, you know, estimated and recognized, and you don't have to wait until that contingency that causes the variable consideration is resolved. So that's the biggest change there, and also there's a significant financing component, so there's a big difference in time between when you're paid for something and when you receive that good or service. And then step 4 is allocate that transaction price. Again, it's very intuitive, right? So I had that determine what that big bowl of money was in step 3, the transaction price. And now in step 4, I'm allocating it to the individual performance obligations, the units of accounting, if you will, that we determined in step 2. And then step 5, I get to recognize revenue. I recognize revenue either over a period of time or at a point in time. And again, if you need a refresher on that type of stuff, I would say take a look at Rev Rec 4, where we talked about Step 5 and disclosures and that kind of stuff. So that's just kind of a brief refresher. And again, this webinar is really just kind of trying to focus in and give some specific examples of concrete differences that are caused by implementing those 5 steps. And the first industry we're going to talk about is software and SaaS, okay? So the biggest change is that first row of bullet points, which deals with VSOE, Vendor-Specific Objective Evidence. So VSOE is basically when our client, that vendor, sells that item completely by itself, just all by itself. So in software, it's generally considered like a license, and generally you would have contract support with that license. Well, if I just sold that license or I just sold that customer support all by itself, that would be VSOE. And previous to this new accounting standard, you had to have VSOE. If you didn't have VSOE, then you had to recognize revenue ratably over the period. You couldn't, say, deliver the license up front and recognize revenue for that license if you didn't have VSOE for that license. There is some exceptions to that with the residual method and that kind of thing, but generally you couldn't recognize revenue. Now, that first bullet point on the right side, which is that you don't have to have VSOE. 606 says that you don't have to have vendor-specific objective evidence. Step 4 is where you determine how to allocate things, and you don't have to have VSOE to allocate things anymore. You can allocate the transaction price between your different deliverables, say software license and maybe some customer support. You can allocate that based upon what's called standalone value, which is very similar to VSOE. It's when you sell that item by itself. Or you can do estimates of what you would sell that item for by itself. And so that's a very big change, and I've seen a lot of the SAB 74 disclosures of some early filers and folks who are public companies. And just give you a background here, the SAB 74 disclosure is a public disclosure that public companies make that says, here's some accounting pronouncements that are coming out, and here's how it's going to impact us. And I've looked at a few software companies, and that's the biggest change by far, which is that now they are probably going to recognize revenue sooner than they would because they don't have to have VSOE. And we've got examples for all of these, so it'll hit home the concept if I'm not articulating it very well. The second big change is the second row of bullet points, which is a variable consideration is recognized when the contingency is resolved. So previous to 606, revenue had to be fixed and determinable under SAB 104. You couldn't have variable consideration and recognize that variable consideration until whatever contingency creates the variable consideration was resolved. For example, in the software industry, generally you would see, a sales or usage base. So however many users use this particular license, we get an extra amount of money for every single user or every single user over a certain amount. It used to be, prior to 606, that you would have to wait until those additional users logged on, and that's when you could recognize variable consideration. For 606 now, this new standard, moving to the right side, the second bullet on the right side, if you're a SaaS company, if you are a software as a service, you have to, you're not optional, it's not optional, it's required, you have to recognize variable consideration on the onset. You don't wait until the variable consideration contingency is resolved. You estimate how many additional users you might have, and then you're going to be recognizing that over the contract period. You don't wait until the variable consideration trigger occurs. And that's only applicable to SaaS companies. So distinguishing between whether you are providing a software as a service, like hosting a platform, or you're literally giving the code to your entity is still a very crucial determining factor that you need to think about. And then the third biggest change to the software and SaaS industry deals with upfront fees, okay? So what I mean by that is sometimes a contract might have an upfront fee, like a quote-unquote activation fee, or it might have upfront fees that are ostensibly for services, like, hey, let's customize this SaaS platform. I have a basic SaaS platform, and I want someone to customize it for my particular entity. And I would charge maybe a $1 million licensing fee for the year, and then maybe a $100,000 upfront fee to customize that particular license to something that I wanted. It has my own logos on it or something like that. Previous to 606, you automatically had to take that additional upfront fee, the $100,000, if you will, in this hypothetical example I'm rolling with, and you had to recognize that over the longer of the contractual life or the estimated customer life. So even though the contract might be 1 year, if that customer is going to renew, and typically customers do, then I might have to recognize it over the customer life, which would have to estimate what that might be. Okay? And of course that defers revenue, and also it's difficult estimating. Now, upfront fees might not necessarily be deferred. It depends if they create what's called a material right. And what I mean by that is if the upfront fee that you have to pay in year 1 to create the customization, if that's tantamount to a discount for years 2, 3, 4, and 5, because you don't have to pay the customization fee, then that would be considered a material right. And then I would have to defer over the longer of the contractual life or the customer life. Then I would have to defer over the estimated customer life. But if the upfront fee is small, right, like maybe say less than 10%, I can just recognize that revenue over that first year, and I won't have to estimate the customer life and recognize it over that period. So examples are how I learn best. I'm sure that's how you learn best. Let's jump right into some examples for software, okay? A new software entity enters into a contract to deliver a license to a customer and provide 1 year of customer support. This is a very simple example and very common in the software industry. The software is installed on the customer's hardware. Okay, now that's key, because when you install software on the customer's hardware, that means it truly is software. Okay, hosting relationships are treated differently, and that's when I don't load things onto the customer's computer. So that's why that's in the fact pattern there. So the software is installed in the customer's hardware and functions as intended without any customer support. The contract price for the license is $1 million and $500,000 for the customer support. It's called PCS. The entity is a new software entity. It has little history of PCS renewals. Okay, so PCS renewals are another way of saying when I sell PCS by itself. When a customer says, I've already bought a license from you, I've already had a year of customer support, I want to buy an additional year of customer support, that constitutes a standalone sale of customer support. Okay? So this particular entity has very little history of these standalone sales of PCS. So that means they don't have VSOE. But the entity does estimate that in the future, when people do renew their customer support, that they're going to charge $600,000. And they estimate that if they sold a license without customer support, that they would probably sell it for about $900,000. Okay? So the question is, how would I recognize revenue under legacy GAAP versus 606? So under legacy GAAP, because it's a new entity and they don't have a lot of history and they don't ever sell these things by themselves, then you wouldn't have VSOE for anything. Okay? So under legacy GAAP, you would recognize a zero revenue, and you would recognize that the contract amount ratably over that customer support period. You wouldn't recognize anything just to the license. You'd have to combine the license and the customer support as to one unit of accounting because you didn't have VSOE for either of them. Now, because that concept of VSOE goes away, under 606, I get to recognize $900,000. Well, where do you get to $900,000? Let's go back to the fact pattern real quick here. The $900,000 is an estimated standalone selling price. You see, at the very bottom bullet point, I had a $600,000 estimated PCS amount and a $900,000 estimated license without PCS. That totals to $1.5 million, which equals the contract price in the first bullet point. And so I would allocate the $1.5 million transaction price based upon the relative standalone selling prices of PCS and a license. And so that's where you would come up with your $900,000 that you would recognize on day one when you deliver the license. So quite a big change, as you can see. All right, so let's move into another example here, okay? This one deals with variable consideration and distinguishing between software and a SaaS company. A software entity enters into a contract with a customer to license, quote unquote, the software entity's hosted solution, meaning we don't install it on the customer's hardware, for 1 year for up to 2,000 users for a minimum of $2 million, plus every single additional user above that 2,000, we're going to charge you an extra $1,000. Okay? It's important to distinguish this is a SaaS company now. Okay? I have to estimate variable consideration for SaaS companies. So, based on historical experience, the software entity estimates that the customer is going to have about 2,400 users. That's 400 users above the minimum at $1,000 a pop. So what is that? $40,000. So it should be 400,000. Through 6 months, the customer has 1,200 users. Okay. So how much would the revenue be through 6 months under legacy GAAP versus 606? So under legacy GAAP, I can't estimate variable consideration, okay? So under legacy GAAP, all I can do is recognize revenue for my 6 months of work that I've provided, the 6 months of services, okay? So going back to the fact pattern, we said it was $2 million fee that was fixed, and as of 6 months, we only had 1,200 users. We haven't gone above our 2,000 minimum, so there hasn't been, the contingency hasn't been resolved, so I can't estimate any kind of variable consideration under legacy GAAP. Instead, I just have to recognize half, because I'm 6 months into it, of my licensing fee. Whereas under 606, I would say, hey, I get to estimate how much variable consideration I'm going to get, and I get to recognize that variable consideration ratably over this period. And in this case, it'd be $1.2 million, which is simply just the fixed fee of $1 million plus half of the variable consideration I think I'm going to get. And the variable consideration we said was an additional 400 user at $1,000 a pop, or an additional 400,000. And so half of that would be 1,200. All right. So now, let's do the exact same fact pattern, okay? Everything is the same, right? The fixed fee, the minimum number of users, the price per additional user, even the estimated number of users are the exact same thing. The only thing that's different now in this example is that now I'm going to be installing this software on the customer's hardware, okay? Meaning that it's software, okay? It's not a hosted solution, it's software. And software is an intellectual property, okay? And when you have sales or usage-based fees, and this applies not just to software, but to all entities, but it predominantly hits software, which is if you have a sale or usage-based fee, a variable fee that you increase by the number of usage or users, then you would, and it's based upon an intellectual property, you don't estimate. That's one of the instances where you don't estimate variable consideration now, is if the variable consideration is based upon completely or predominantly, is the word they use, a license of intellectual property, aka software in this instance. So how much revenue would I recognize at the end of the 6 months under legacy GAAP and under 606? Under both legacy GAAP and 606, I would recognize $2 million. You might say to yourself, wait, Michael, you said it was $1 million for legacy GAAP when it was SaaS. Why is it $2 million for software? Well, that's because for software, both legacy GAAP and 606, software you deliver at a point in time. I've given you the code, I'm done. I don't have to worry about it, right? So you deliver it at a point in time, and I would recognize the fixed amount under legacy GAAP. I wouldn't do any estimates of usage. So I'd recognize $2 million, the fixed amount. And then as the contingency is resolved, I would recognize more money. Same thing with 606. It doesn't change, right, under 606. And I think that's a very important distinction to make between software and SaaS. Again, you would recognize the $2 million licensing fee, but you don't have to estimate, and you should not estimate, the sales or usage base, the additional 400 users in this case. All right, let's move on to the last software example, upfront fees. A software entity enters into a contract with a customer to license the entity's hosted solution, a SaaS solution, software as a service, for 1 year for $2 million, okay, $2 million, remember that number, and a non-refundable $150,000 upfront fee to customize that SaaS application for the customer's intended use, okay? So, $2 million, $150,000 upfront fee, that's a little bit less than 10%. The software entity estimates that the customer life is 3 years. So even though this contract term might be for 1 year, we think that this customer is going to renew a couple years, and it's going to be 3 years of the customer life. How much revenue should be recognized for GAAP after 1 year under legacy GAAP, and how much under 606? Okay? So under legacy GAAP, okay, I would have to take that upfront fee, that $150,000, going back to the fact pattern here, okay, $150,000 upfront fee. I would have to recognize that over the longer of the contractual life, in this case it's 1 year, or the customer life, which we're estimating to be 3 years. So I'd have to take that $150,000, I'd have to recognize it ratably over 3 years, or $50,000 a year. That's how you get to the $2,050,000. Now, though, with 606, I don't have to do that unless that upfront fee is tantamount to a material right. A material right can be thought of as a discount on future products and services, a discount that you would not offer other customers who have not previously bought things from you, who are not already in a contract. It's something that you're giving this particular customer because they've entered into this contract with you, okay? And so you kind of look at it as a discount on future products and services, okay? And so what the interpretive guides are saying, and this isn't anywhere in the codification, but generally 10% is considered significant or not. So because these upfront fees are only $150,000 out of a $2 million license, okay, then they're less than 10%. One could make an argument that they aren't a material right, meaning, okay, in year one you paid $2 million for the 1 year license plus $150,000 upfront fee, and then years 2 and 3 you got kind of a discount because you didn't have to pay for the upfront fee again. Once it was customized to your liking, you didn't have to re-customize it in years 2 and 3. So you kind of had a discount for years 2 and 3 in a sense, but because that discount is kind of less than 10%, some could interpret that as not being a material right. And because it's not a material right, then all you would have to do is recognize that upfront fee over, depending upon whether it's distinct or not, either when the implementation services are done or ratably over that first contractual period. You wouldn't have to estimate the customer life. So that's a big change, as you can see, for software. Software is arguably the most impacted by 606. So let's talk about manufacturing. I'm sure we have a lot of folks in manufacturing and such. So before 606, you would recognize goods that you manufactured when the risk and rewards transferred to the customer. Basically, FOB, shipping, or destination. Okay. Now, that's still probably going to be true for a lot of our folks, but if you're creating a good that's significantly customized and the entity has a right to payment, meaning a right to reimburse for the cost plus a margin, if both of those things are true, then that revenue would probably be recognized ratably over time as you are creating the asset, as you're creating WIP. So what I mean by that is if I'm creating a significantly customized piece of good and I have a right to payment, that technically qualifies for revenue to be recognized over time. One of the 3 criteria for revenue to be recognized over time is that the entity is creating an asset for the customer, and the asset has no alternative use to the entity. It can't sell to someone else, which when you're creating a significantly customized piece of a good or service, you really can't sell that to someone else because it's customized. And if I meet that and I have a right to payment for cost plus a margin, then that is a good or service that is recognized over a period of time. So that's a different. You might see an acceleration of custom manufacturing revenue under this. The second bullet point, learning curves create volatility in gross margin. What I mean by that is, under previous to 606, if I were to say promise to build you 10 widgets, okay, and I'm going to charge you $10 for each one, so $100 altogether. And I would recognize revenue 1/10 as I deliver them. If I use the units delivered method, I would just recognize them, the amount of revenue would be the same for each one. And now my cost, let's say it took me a lot of time to figure out how to build that first widget. And I incurred a lot of costs for that first widget, and not so much cost on the last widget that I made because I kind of perfected my manufacturing process. There would be volatility in margins under legacy GAAP because I would only recognize revenue 1/10 as I deliver each of the 10 widgets I'm supposed to give you. But the cost would be what it is. So revenue would be a fixed amount per unit, and the cost would be whatever it is, and so I'd have a negative margin for that first unit if it took me a lot of cost. And I'll show you an example of that. Now, moving to the second bullet on the right, that goes away if the performance obligation is considered a series of distinct goods or services that are substantially the same. What I mean by that is, if I'm creating, say, customized or something specialized widgets, if you will, and I can recognize each of those over time because they're customized, and I'm giving you 10 widgets, and they're all basically the same widget, right? Now I don't consider that 10 performance obligations, 10 different units. I consider it one performance obligation. And I consider it one performance obligation, and I would measure my progress towards completion using cost. And so my margins would be the same, and you'll see an example how this works, would be the same throughout the life. The last three changes that affect manufacturing, I'll talk about together, which is tooling. Tooling is when you're going to build kind of a prototype or a piece of equipment or machine or tool, if you will, to perform on like a long-term supply agreement, right? So tooling is when I'm doing that. Generally, I would either capitalize or expense that previous to 606. But now, as a result of 606, I might, if certain criteria are met, I might have to treat that as a separate performance obligation, allocate some revenue to that, and defer some revenue. The second to the last bullet point, commissions. Previous to 606, folks kind of had a policy election. Do I want to capitalize commissions that I pay and recognize that over the life of the contract that relates to the commission, or do I just want to expense it? And most folks just expensed it. Now, you don't have an option. You have to capitalize the cost, commission cost, and recognize that over the period of benefit, which is generally going to be the contractual period. There's a practical exception, which of course is when a contract period is less than 1 year. And the last big change is strict bill and hold criteria. So bill and hold is when I literally finish completing something, I bill the customer, I recognize revenue, but I'm not going to ship it to the customer. The customer's not ready for it yet. And that's called bill and hold. And SAB 104 and the SEC created some very strict criteria that needed to be met. Now, bill and hold still exists, but it's principles-based. And there's two very key differences. And one is that it used to be that one of the strict criteria was that I had to have essentially a bill and hold, an explicit agreement to enter into a bill and hold agreement with the customer. I had to sign something. I'm entering into a bill and hold with you. Now that goes away. You don't have to have that. There just has to be a legitimate business purpose for the bill and hold. And the other thing is that there had to have been previously a distinct delivery date. I'm going to deliver on August 2nd. Now, there doesn't have to be a distinct delivery date. So let's go into some examples here. An entity enters into a contract with a customer to build a specialized piece of equipment for $1 million, and it has no alternative use to the entity. So that piece of equipment is very specialized. I can't refurbish it and sell it to someone else. It's too specialized. At year end, we're about 50% done with this very specialized piece of equipment. And the entity has an enforceable right to payment, which includes a reasonable profit margin, and that's very key. If it's only a right of payment for cost reimbursement, and I don't get any margin from that, then that changes the answer. So how would I recognize revenue for legacy GAAP versus 606? So in a legacy GAAP, that specialized piece of equipment would be recognized when the risk and rewards of ownership have transferred to the customer, basically when I have shipped it to them, right, whether it's FOB shipping or destination. So I'd recognize no revenue at year end because I haven't finished making it and I haven't delivered it yet. That's legacy GAAP. But 606, though, because that asset that I'm creating has no alternative use to me, the entity, I can't refurbish it and sell it, and because I have a right to payment for work to date, including a profit margin, I get to recognize revenue as I'm building it. So that means, going back to the fact pattern here, I think we said we had a $1 million contract. Yes, it was for $1 million, and we're 50% done. So that means at year end, I got to recognize $500,000. So obviously, a big change there in timing of revenue recognition. All right, so go ahead and get your poll questions out. I think I might have given away the answer on this already, but we want to make sure that you get your credit. And the question is how much of an impact do you believe 606 will have on your clients? Give everyone a few minutes here to answer those questions. Again, just make sure you get your credit. It's got to be an engaged you. All right, well, let's go ahead and move in. Hopefully everyone's been able to answer those questions. Let's move on to another example in contract manufacturing here, the learning curve example. And this one, we're going to deal with a lot of numbers here, so bear with me. A contract manufacturer agrees to construct 5 identical, never before made, highly customized parts for a customer over the next 2 years. So the importance of it being highly customized is, going back to the previous example, it has no alternative use to me. If it has no alternative use to me and I have a right to payment for cost plus a margin, then I get to recognize that over a period of time. And if I get to recognize that over a period of time, then, again, this goes back to step 2, and our webinar from step 2, if I recognize something over a period of time and I'm providing a series of these goods or services, in this case 5 identical ones, that's a series of goods or services that are substantially the same, and I can recognize each one of them over a period of time. So the rules say that I have to look at that as one performance obligation. Even though I'm delivering you 5 identical units, I have to look at that as one performance obligation. So let's get to the numbers part. The unit price that I'm selling each one for is $100, so $500 in total. But I expect total cost of $400, okay? So a total of a 20% margin. And the reason I expect $400 is because there's a learning curve, okay? That first unit, that prototype one, that's going to take me a long time to manufacture, okay? In fact, it's going to take me over half of my total cost to manufacture that. $200 is my expected cost. And then the other units 2 through 5, I've perfected it. This is a very simple example. I'm going to do $50 a pop for those, so the total for $200 plus $50 for the remaining widgets, if you will, are going to be total $400 cost. The entity has determined that each part is distinct and that the contract is a series of distinct goods or services that are substantially the same, okay? How much revenue and margin should be recognized as each unit is delivered? So let's see how we differ between Legacy GAAP and 606, okay? So under Legacy GAAP, you would probably recognize this revenue under the units delivered method. As you deliver each unit, that's when you would recognize revenue. And you would recognize revenue equally for each unit. So if you look at the first 2 columns under Legacy GAAP, you would see that it's $100 per unit, no matter if it's the first unit or the units 2 through 5. But the cost is what it is. You would recognize the cost at whatever you incurred. So that first unit, that one that took a long time to figure out, you would have cost of $200, but only revenue of $100, and you'd have a gross margin of -100 or -100%. And then every single unit after that, the cost would be whatever the cost is, $50 per unit, and you would have a margin of $50 or 50%. So you would have this big volatility in margins because you had this big learning curve, right? Well, that goes away now, right? Because now if it's a series of distinct goods or services that are substantially the same, right, and it's recognized as one performance obligation, not 5 separate performance obligations, then I would probably use a cost-to-cost method. I would say, what are my total expected costs to provide all 5 of these units, and I would measure my progress towards completion by whatever my cost incurred to date was. So for the first unit, I would recognize $250. And the reason why is because I would take $200 cost incurred to date over my estimated $400 of cost times $500 my total revenue that I'm going to get for all 5 units. So I'd recognize 50% of my revenue, right? And my cost would be whatever my cost is, just like it was under Legacy GAAP, $200. And that, as you see, results in a consistent margin, which now my margin for the first unit would be a positive $50 or 20%, and my margins for units 2 through 5 would be $13 or a positive 20%. So now the margins are going to be consistent. Let's move on to healthcare, okay? So the biggest changes with healthcare really deal with what is the contract price. So previous to 606, you would recognize revenue and bad debts for uninsured patients at a gross amount. What I mean by that is, let's say I had a patient walk in and, $10,000 was what the medical bill would be, but they're uninsured and they're really only going to pay me $1,000. Okay, so previous to 606, I would recognize gross revenue of $10,000 and then bad debt allowance or expense of $9,000 for a net revenue of $1,000. And the key there is that it would be net revenue. I would take that bad debt, and it wouldn't be an operating expense. Instead, it would be above gross margin. That's how the healthcare companies would present that by the rules. So they would basically have a $10,000 of gross revenue and $1,000 of net revenue. Now, for uninsured patients, you have to consider what you're actually going to collect from that person. That is what the transaction price is per step 3. So if I have an uninsured patient and it's going to be $10,000 as the contractual price, the normal price we charge for the emergency services, but I know based upon my experience that we're willing to accept $1,000, then the transaction price isn't really $10,000. The transaction price is really $1,000 under 606. So what I would have is I would have gross revenue of only $1,000, not $10,000 like I would under legacy GAAP. Okay? And that second bullet point is kind of related to the first bullet point, which is that bad debt expense would be recognized as operating expense. It would be below gross margin now. And so let's say that the customer actually paid the full $1,000 that I expected to get paid, I would have no bad debt expense. Or if the customer only paid $800 of the $1,000 I expected, I would still have revenue of $1,000 because I expected them to pay $1,000, but then I might have bad debt expense that's a operating item as negative $200 for that. So let's go ahead and let's go put some numbers into this in an example. A hospital treats an uninsured patient, and the hospital bills the patient $10,000, but experience with similar patients indicates that the hospital is only going to collect $1,000. Okay? 6 months after treatment, the customer has paid $800, and the hospital decides to cease collection efforts. Okay? They're done with that customer. They're not going to get any more money. How much revenue, bad debt, gross margin, and should be recognized at 6 months under legacy GAAP versus 606? So, again, under legacy GAAP, I would recognize revenue for the full amount, which would be $10,000, okay? Whereas for 606, I only recognize revenue for the estimated amount that I think I'm going to collect, okay? And then, under legacy GAAP, my bad debt would be $9,200. It would be the amount that we never thought we were going to collect, $9,000, plus the $200 that we ultimately still didn't collect out of the $1,000 we thought we would. And that's above gross margin. So your gross margin would be $800. Now under 606, you don't have that bad debt of $9,000 or anything because you're only recognizing revenue for $1,000, and bad debt is not above the gross margin anymore. So your gross margin would be $1,000, and the corollary to that is your bad debt would now be an operating expense, and you would have a $200 operating expense, and so your net income would be the same, but how it's presented in the financial statements and your gross margin and your gross revenue would change significantly. So let's talk a little bit now about some engineering and construction, okay? So previous to 606, contingent fees, okay, variable consideration, things that aren't fixed and determinable that could sway one way or the other, you wouldn't recognize those for a construction and engineering company until really they are deemed probable and reliably measured. Now, probable isn't defined as a percentage anywhere in legacy GAAP or even 606, but in practice, it's generally considered to be about 70% certain, okay? So probable generally means 70%. So if you were 70% or more certain that you were going to earn that variable consideration, you could then recognize it at that point in time once you became 70% certain. Now, moving to the right side, the first bullet on the right side here, you would estimate those contingent fees at the onset of the agreement. So even though you might not be 70% certain, you might be only 30% certain that you're going to get this incentive, this variable payment, this bonus payment, right? So you might only be 30% certain, you're not probably certain, only 30%. You would still recognize some of that variable consideration, and the example will show what I mean by that, but you would recognize a weighted percentage of that. The second bullet point, which is excluding the cost of uninstalled material. So this is when I'm building a big building for someone, and I have a big piece of equipment or part of that building that is I buy from a third party, and all I'm doing is have it drop shipped to the customer's location, and it's just sitting there, and I haven't installed it yet into the building. I haven't integrated it into the building yet. Okay. It used to be previous to 606 that cost that I incurred to buy that piece of equipment, that I would not include the cost of buying that equipment in my estimate of cost to cost, my percentage of completion. Now there's a little bit of a relief to that. Now what 606 allows you to do is, for those uninstalled materials, you can recognize revenue up to a zero profit margin. So whatever my cost that I incurred to buy that item, have it drop shipped to the customer's location and just sitting there, whatever that cost is, I can recognize the expense because I bought it, and I can recognize the revenue at zero margin. So it has zero net income impact, but at least I get to recognize some revenue on it now. The third bullet point is more semantics than anything, but for engineering construction, you have unbilled accounts receivable, and then once you build it, once you actually mail the invoice, it would turn from unbilled to accounts receivable. Well, now that kind of goes away. You could still call it unbilled if you want, but technically it's a contract asset. You basically recognize the contract asset whenever you have performed services, but you don't move it from a contract asset or unbilled receivable to AR until you have an unconditional right to that to invoice, meaning the only thing that's preventing you from invoicing maybe is the passage of time or something. But you don't have to fulfill any other performance obligations in order to bill the customer. So even if you haven't sent the invoice, right, but I could send the invoice if I wanted to, then I can move it to AR, even though I haven't even sent the invoice. So that's a little bit more semantics than anything, but it is a change to be aware of. So let's get into a couple of examples with construction engineering. Okay? A construction contractor enters into a contract with a customer to build a building on land owned by the customer in exchange for a fixed fee of $10 million. Okay? The scheduled completion date is June 30th. The fee will be reduced or increased depending upon the completion date. So I complete it early, I get paid more. I complete it late, I get paid less. For each day before June 30th that the building is completed, the contractor receives a $50,000 bonus. So I want to get that done as soon as possible, because every day I get it done ahead of schedule, I get an extra $50,000. For every day past June 30th, the contractor loses $50,000. So I really don't want to be late on this. In addition, okay, I'm going to make this one really complicated. In addition to that variable consideration, there's another variable consideration, and that is if the entity meets certain energy efficiency requirements, the contractor will receive a $1,000 bonus. If the building doesn't meet the requirements, the contractor gets nothing and loses nothing. So it's a binary option. Either I get it or I don't. Whereas that first variable consideration was more of it could be a wide range of things. That could be maybe 10 days early or 7 days early or 3 days late. It's a wide range of what that bonus or penalty could be. At March 31st, the contractor is 50% complete and estimates there's a 60% chance the project is completed in 10 days ahead of schedule, and a 20% chance that it's completed on schedule, and a 20% chance that the project is completed 10 days behind schedule. Okay? In addition, the entity believes there's a 90% chance that the building will achieve the energy efficiency requirements. How much revenue should be recognized at March 31st under Legacy GAAP and under 606? Let's break it down. So, we said, and forgive me that it's missing a comma there and a zero, but it should be $10 million, not $10,000. So the fixed price is $10 million, okay? And that's the same under Legacy GAAP or 606. But under Legacy GAAP, I can't estimate variable consideration until I'm probable that I'm going to get it, until let's just say 70% or more certain. So all of those, the percentages that you got there, 60% that I'm going to be 10 days early and 20% 0 days completed right on time, or 20% that I'm 10 days late, all of that, forget about it. It's not probable. I don't recognize anything. Whereas under 606, as you can see, you would do a probability weighted. You would take 60% times 10 days times 50 grand a day and come up with 300,000. And you would probability weight that so that the net amount is $200,000, okay? So then that's one way of determining variable consideration. That's called a probability weighted way of doing it. There's another way of estimating variable consideration that's used when you have a binary option, when there's not a wide array of possible outcomes. Instead, it's just binary. Either you get it or you don't. And that is that, for this particular example, that environmental energy savings. And so under legacy gap, because I'm 90% sure I was going to get it, I would say that I would recognize maybe 100 grand because it's probable of occurring. Whereas under 606, you might say to yourself, well, Michael, why aren't you probability weighting it? Well, that's because under the most likely amount method, it either is or isn't. It's binary. So you would recognize 100% of it even though you're only 90% sure. Okay? That's the difference between the most likely amount method of estimating variable consideration and the probability weighted. And so the transaction price would be $10,100,000 under legacy gap and $10,300,000 under 606. We're 50% complete. The math works out so you have $5,050,000 under legacy gap and $5,150,000 under 606. All right, let's move on to uninstalled materials. An entity contracts with a customer to refurbish a 3-story building and to install elevators for a total consideration of $5 million. The promised refurbished service includes the installation of elevators, is considered a single performance obligation satisfied over time. So this is construction contractors are generally going to have one performance obligation that's satisfied over time, and that's because one of the criteria for being satisfied over a period of time is that the customer controls the asset as the entity is creating or enhancing that asset. And so if the entity owns the land that I'm building the building on, they control the building as I'm building it. So that would be a performance obligation that's recognized over a period of time. And it would probably be one performance obligation because even though I could sell you elevators in this hypothetical example, or I could sell you bricks and mortar or sell you roofing services, I'm providing a significant service of integrating those things. So they're capable of being distinct, but they're not distinct within the context of the contract. So that's why it's one performance obligation recognized over time. So getting back to this example here, we have $5 million as our sales price. The second bullet point here, the expected costs are $4 million, okay? But that $4 million is 1.5 of it is for the elevators, and then 2.5 million is for just other costs like roofing and foundation and bricks and mortars and that kind of stuff, right? The entity is not involved in designing or manufacturing these elevators, okay? And obviously the costs to procure the elevators are significant relative to the entire expected cost of this contract. So the entity uses an input method based upon costs incurred to measure progress towards completion of the performance obligation. As of year end, the entity has incurred $2 million of costs. So again, we have $5 million is the total contract price. We estimated $4 million in costs. That includes $1.5 million for the elevator and $2.5 million of just work that we're doing. As of year end, we've incurred $2 million, which includes $1.5 million for the elevators and $500,000, the difference between $1.5 million and $2 million, for other things that, like, you know, paving and that kind of stuff, right? Other stuff that we're doing that's not just simply procuring equipment from other third parties. At December, the elevators have been delivered, but they're not going to be installed until June of next year. How much revenue should be recognized at year end under 606, the new standard? And that is a polling question. Again, you don't have to have the right answer. You just have to have a answer, and that is going to be in Engage You. So please, by all means, make sure you get your CPE credit. You know, we got a number of different numbers there. Give everyone a couple seconds here. Make sure you click that in, get your CPE. All right. So the answer is a 2.2 million. Okay. And how did I get there? How did I get to that 2.2 million revenue? Let's go ahead and close the polling question, and I'll show you. Okay. So revenue is 2.2 million, and if you look at footnote A, what you're allowed to do now is recognize revenue for uninstalled materials if they are a big purchase uninstalled materials and you didn't manufacture them, you're just simply procuring them for the client, for the customer. In this case, you're just buying an elevator from an elevator company and then installing it in the building. The 1.5 million of elevators would be recognized at zero margin. So you'd have 1.5 million of revenue with a zero margin, plus you would have 20% of the remaining revenue. So back it up here. We said that as of year end, we had 2 million of costs that we incurred. 1.5 million was the elevator. So that means $500,000 of other costs have been incurred. That's legitimate costs that we're doing. It's not simply procurement. So that $500,000's got to be divided over, not the $5 million overall contract price. You have to reduce it for the amount of the cost of the elevators that you're excluding. So it's divided over 2.5 million, and that comes to 20%. And you take that percent and you multiply it by the revenue that is in the contract less the revenue allocated to the elevators at zero margin. So that's how you get to your $3.5 million. So 1.5 million plus 20% of 3.5 million comes to your $2.2 million. And then your cost is what it is, which is just the 1.5 million elevator plus the $500,000 in other actual legitimate building and construction costs. So that's how you would recognize uninstalled materials at a zero margin under 606. All right, let's talk briefly about some broker-dealers. Anytime I talk about 606, generally when I talk to folks who are in the financial services industry, banking or broker-dealers, they generally are like, it doesn't apply to me because it doesn't apply to financial instruments. And that is true. It doesn't apply to financial instruments, but there are a lot of services that broker-dealers and other financial institutions provide that are within the scope of 606. And some of the common broker-dealer services that are provided that are within 606 are trade execution services or custodial or administrative services, underwriting, advisory services, things like that. So these are things that aren't a financial instrument per se. They're a service that's provided. You're not selling them a financial instrument so much as you are providing a service. And that's within the scope of 606. So here are some of the big changes, and I got these from looking at a SAB 74 disclosure for Oppenheimer funds. And what they are basically saying is that they, for underwriting services, sometimes, let's not use underwriting, let's say that they're doing due diligence for a business acquisition or a business sale, right? And they would incur some retainer and progress fees up front. They would, previous to 606, recognize those things ratably as they're performing the services of doing due diligence for a business acquisition or whatnot. But now, the retainer and progress fees are likely not going to be, you're probably going to have one performance obligation. That performance obligation is, I'm going to provide you a due diligence work over a business acquisition. So you would be less likely to have a multiple performance obligations where you could recognize some of that retainer or progress fees as you're performing. You would probably defer the retainer fees and progress fees until you've completed that business sale or whatever it might be. And then the second biggest change here is underwriting expenses. Okay, so previous to 606, you would have your underwriting revenue, and underwriting is when I'm helping sell securities for a customer, and I might incur some significant costs like some attorney fees and accounting fees maybe even, and I would take that revenue and I would subtract out the cost that I incurred to provide that revenue, and I'd recognize it net. And now, underwriting expenses are recorded gross. You would not net them. You would recognize them gross. So that's the biggest changes for broker-dealers, and that leads us to our last polling question. Want to make sure everyone gets their CPE. What best characterizes how ready your clients are? What are the chances they deferred another year? Very poor chances. They've attended webinars and thought about it. That's good. They developed a gap memo and they're still assessing. That's a client that's really doing good for our client base. Or they've developed a gap memo and they've already started implementing. That's even better. Or what's not very likely, except for all of our auditors out there, I hope is likely, which is bring this 606 on. I'm ready for it. I'm a master at it. So a couple seconds now to enter that in. Make sure you get your CPE credit. And let's go ahead and close that poll out. And that's all I have to talk about for today, folks. This is Rev Rec Part 5. We're going to have Rev Rec Tech and Life Science come up. I think it's on the 14th. Maybe that's for the external folks. But we're going to have a Tech and Life Science industry specific, and then we'll probably have some other industry specifics. If you have a desire for an industry specific for your industry, by all means, email me. If you have any questions about anything I've talked about today or just 606 in general, feel free to email me. That's what I'm here for. Anyways, I appreciate everyone. Everyone have a great day, and I appreciate it. Have a good one. All right. Oh, man.